The interplay of greed and fear is a fundamental aspect of investor psychology, significantly influencing market dynamics. Here's a detailed analysis. Understanding greed and fear. Greed. In the context of investing, greed manifests as an excessive desire for profit, often leading to irrational exuberance and a willingness to take on excessive risk. It drives investors to chase high returns, often disregarding fundamental analysis and ignoring warning signs. Greed can fuel market bubbles, where asset prices become inflated beyond their intrinsic value. Fear. Fear, on the other hand, is the emotion that drives investors to protect their capital. It arises from uncertainty, market volatility, and the prospect of losses. Fear can lead to panic selling, causing sharp market declines and creating opportunities for astute investors. The impact on investment decisions, emotional decision-making. Greed and fear can cloud judgment, leading to impulsive and irrational investment decisions. Investors may buy high during periods of greed and sell low during periods of fear, contradicting the fundamental principle of buy low, sell high. Market volatility. These emotions contribute significantly to market volatility. Sudden shifts in sentiment, driven by fear or greed, can cause rapid price swings. This volatility creates both risks and opportunities for investors. Market cycles. Greed and fear play a crucial role in the formation of market cycles. Periods of prolonged greed can lead to bull markets, while periods of intense fear can trigger bear markets. Key concepts and tools. The Fear and Greed Index. This index, developed by CNN Business, attempts to measure investor sentiment by analyzing various market indicators. It provides a gauge of whether the market is driven by excessive greed or fear. It is important to note that this is one tool and should not be used in isolation. Behavioral finance. This field of study examines the psychological factors that influence investor behavior. It provides insights into how cognitive biases and emotional factors can lead to irrational investment decisions. Understanding behavioral finance can help investors to recognize and mitigate the impact of greed and fear. Be fearful when others are greedy, and greedy when others are fearful. This famous quote, attributed to Warren Buffett, encapsulates the contrarian approach to investing. It emphasizes the importance of going against the crowd and capitalizing on market extremes. Strategies for managing greed and fear. Develop a long-term investment plan. A well-defined investment plan can help to mitigate the impact of emotional decision-making. It provides a framework for staying disciplined and focused on long-term goals. Diversify your portfolio. Diversification can help to reduce risk and mitigate the impact of market volatility. By spreading investments across different asset classes, investors can reduce their exposure to any single investment. Practice emotional discipline. Developing emotional discipline is crucial for successful investing. This involves recognizing and managing emotional biases, such as greed and fear. Stay informed, but don't overreact. It is important to stay informed about market conditions, but avoid overreacting to short-term fluctuations. Focus on long-term trends and fundamental analysis. In conclusion, greed and fear are powerful emotions that can significantly impact investment decisions. By understanding these emotions and developing strategies to manage them, investors can improve their chances of long-term success. Sources and related content.